Insight is coming to you live from Hong Kong as the city grapples with questions around a devastating fire at a residential building that has killed at least 44 people, with many more still listed as missing. The city's worst residential fire in more than half a century is a stark reminder of the risks as we rush to rebuild and renovate, and of the need to do so safely. Our thoughts remain with those affected even as the city presses on. I'm Yvonne Mann. We will have more on that still developing story here this morning. Here's what else is ahead on the show. China's property sector suffers a fresh blow, with Vanke proposing a delay in a bond repayment, sending some of its notes to record lows. Investors are now doubting Beijing's support for even its largest developers. CreditSights Zerlina Zeng will join us to discuss whether China's real estate sector is in big trouble once again. We'll also get perspective from global investors and economists on the wider impact. We have Moneta's Aoifinn Devitt saying, and Natixis Alicia Garcia Herrero, who will assess those risks in China. And as competition and foreign investor interest heats up in India's financial services space, we speak to one of the big players, L&T Finance MD and CEO Sudipta Roy, joining us with his outlook. We are checking markets here this morning. It looks like when it comes to global equities, we are very much close to erasing some of the losses that we saw in November. So December certainly has been much more of an upbeat one as we count down to the end of 2025, thanks to, of course, that Fed pricing and the shift in expectations really in this week. And you have the likes of the BOK really talking about the rate near neutral level, considering financial stability. So we're watching that pause from the BOK here this morning, but the markets are still doing, relatively speaking, pretty well. You take a look at how the CSI 300 and Shanghai is still doing okay. In China, HS Tech is flat. We'll talk a little bit more about that Alibaba story and that list that it may have been on as well from the U.S. But then again, we're watching very closely, of course, the moves in property, right? So certainly the Vanke news was something that did catch a lot of traders and bond traders off guard here this week. We have, of course, the update of what we've been seeing. Some of these bonds, of course, once again being suspended after dropping to 30 to 40 cents to the dollar here this morning. You're seeing that in the equity space as well, from property to banks, on the possible concerns around contagion now after we have seen these Vanke dollar bonds tumble to record lows. That surprise proposal to delay repayment on a local bond has renewed concerns over a deepening housing crisis. It's also sent some of the builders' dollar notes, as we mentioned there, to new lows. For more on this, let's bring in our China credit reporter, Trista Law, on this request from Vanke to delay that bond payment. Why do you think that's such a big deal?
Yeah, so Vanke has been long time, considered as one of the, healthiest and biggest developers in mainland, which has not been defaulted yet. Earlier in the property crisis, we see some developers like Evergrande defaulted and Country Garden defaulted. But Vanke, because of, one of the biggest shareholder of Vanke is actually Central Metro. It's a state-owned enterprise. So for a long period of time, investors actually have the hope that Vanke can survive because of the continuing support from its largest shareholder. But right now, with the potential the bond extension proposal, it actually raised a lot of concerns from investors to take about whether right now government are trying to rescue the project instead of the developer itself.
If there is any sort of absence from the central government, what implications do you see this could have on the whole sector now?
Yeah, I think the government definitely taking more cautious approach to support this whole sector, because previously we have seen, Vanke's biggest shareholder, Central Metro, have rolled, 30 billion yuan loans to Vanke, and Vanke has been always rely on that kind of credit line to support them to repay the debt. But right now we are seeing they are tightening the financial terms, so it's actually that's why cause investors concerned about whether Vanke will be default finally, and whether they can still survive from this.
And in terms of the next sort of signpost, what are the next things to watch really for Vanke now?
Yeah, so Vanke will meet investor on December 10th and then trying to seek their support about the bond extension. So we will definitely keep a close eye on that to see whether they can get enough support. If it cannot, it will be possibly a default. And then, by the end of next June, next year, so bankers actually have, about 13 billion yuan notes coming to due. So that's a big number there.
You seem to be seeing a bit of reaction in the property space here, not just when it comes to Wanka now. I'm just wondering, what are analysts telling you about the potential for contagion in the sector here? And, is there any sort of risk of liquidity pressures from other developers now that we need to focus on?
Yeah, I think overall it's definitely really negative news for the whole already fragile property sector, right? It will definitely, undermine the confidence a lot. And then customer will once again to doubt, they might be more reluctant to buy homes. And then further on, the sales price, will slump further. So I think there's a more concern here. I think what's happened to Vanke is actually raise the question about where's the end of this property crisis.
Yeah. Trista, thank you. Trista Luo there, our China credit reporter, talking about the re-emerging risk when it comes to China's real estate sector there. And certainly we'll have more analysis on what's going on in this property crisis coming up. Zerlina Zeng of CreditSights joins us in the next hour. Now, in terms of what to expect here, these growing headwinds in the macro side of things for China. Investors will be watching out for fresh policy signals from Beijing, especially with that upcoming Central Economic Work Conference next month. For more, let's bring in our Asia equities reporter Xiaomi Cha on how important this meeting is and what are investors watching out for.
Yeah, so it seems like the investors are, looking beyond the earnings now. They're looking at the next event and they're looking to see some of that stimulus coming from the policy side of things. Of course, the timing is very important here because we're going to have quite a long lull after this event, which is going to be about mid-December. And then the next political event that we're going to be seeing would be 3 months after the two sessions done. So it really has to come down to whether the policy, the language that they come up with is going to be positive. And this is a very important meeting, high-level meeting of all these people who are going to hammer out policy, especially about economic policy that will really, be the blueprint for next year. So all the head of states and all the SOEs are going to be there. So this is going to be important. Now, this event has the tendency of actually jolting the market. Last year, we saw more than 8% drop in a local benchmark a month after this event. Previous to the pandemic levels, for 3 years, we've seen that it actually raised market. So we can see that it is quite important. What the investors are looking at is the animal spirits.
Yeah, it seems like we talk about this sort of K-shaped economy, right, where you have the macro picture like investment, like property that continues to be in sort of a downturn. Tech still seems to be the one that is the brighter spot in this economy, right? The AI investment and the like. Can the Chinese market continue on just the tech space and this whole AI rally that we've been seeing all year?
Yeah, so we've been hearing a lot about this broadening out of this AI trade. So we've been trying to find out what's next in terms of AI trade, especially in Asia and in China especially. I think there's a whole narrative between China versus U.S. when it comes to chip, the rivalry there. And so it's always been the self-reliance theme when it comes to China tech. But now we have seen some of the pockets of opportunities in companies, Chinese companies that's tied to U.S. as well. So yesterday we've seen a story about Victory Giant that makes PCBs, the printed circuit boards for NVIDIA, for instance. So it kind of highlights that intertwined nature of this tech sector in both U.S. and China as well.
Tell us a bit more about this whole BYD, Alibaba, this sort of letter that was found where the Pentagon concluded that they should be added to this list of companies with ties to the military. What impact do you think it's really going to have on some of these really big names? Yeah,
so back in January, I think, when Tencent and CATL was mentioned in the list, it really impacted their shares. But we're not really seeing that much today, although Baidu, Alibaba, and BYD are slumping. They were this morning. Again, it's not massive moves that we're seeing, though, still. So it seems like the market is kind of aware that there is this list, that oftentimes China is, the Chinese companies are linked to Chinese military. We've seen that in healthcare space with Biosecure Act as well. But going back to 2021, when the list was first released, and this is renewed every year, it seems like people are not very concerned.
Okay, Sang-Mi, thank you. Our Asia equities reporter Sang-Mi Chai there joining us here in Hong Kong. Joining us now is Moneta Senior Investment Advisor and Global Market Strategist Aoifinn Devitt. Moneta is an investment advisor with $40 billion US dollars there in assets under management there. Aoifinn, it's great to have you. I got to get your take on China. The whole prospect of the real estate risks seem to be re-emerging once again in a big way. The market has, for some time, has really kind of overlooked these concerns and really focused more on AI. How important is it, or how much weight are you putting on the risks that are around real estate in China now?
It's interesting. I'd say this has been a slow burn risk in China. It really has been running for about 4 years in the background. And I'm going to go back to the Jamie Dimon discussion around cockroaches and private credit in the US, because there were 2 incidences of cockroaches there. And generally, that has been brushed off as not systematic and not endemic of a larger problem. So I'd suggest also here we have this one, China Vanke, you've mentioned. I think, though, probably there will be a suggestion that this is an isolated thing, or at least a sign of a slow burn problem that needs to be minded at the background. But the attention of China has been firmly, as you said, on the tech side, on that story, on the massive advances being made. So it's a concern. But as we can see in markets seem to be able to hold 2 thoughts in their head at the same time.
How in terms of foreign investor appetite for China, how do you think that's changed? I mean, where you are sitting in the U.S., I mean, do you think, this whole kind of re-rating story is something that we can put in the past now when it comes to the equity market in some ways? Or do you think that there's still quite a bit of risk, investing in this market?
I'd say that China has undergone a transformation in terms of investor sentiment. In recent months, we've seen it go from uninvestable, perhaps over a year ago, when there was still a suggestion that there was simply too much regulatory risk and there was not as much focus. Everything was focused on US exceptionalism. Now, I'd say just the last 6 months, there's been a real recognition of the tech play being able to play out in these different parts of the globe, and a sense that there are some meaningful global players emerging and emerged in China. So that has definitely been a change in sentiment. I'd say in terms of the allocation, the US investor is still only limited in their allocation away from the US in general. I'm speaking for the average private wealth investor. And still they would regard China with some skepticism. It is still in the crosshairs of the trade rhetoric. And I suggest that it's going to be very much a peripheral allocation for them for now.
Okay, interesting. I just want to break this line here. Hold on a second, Aoifinn. We're talking about these wonka bonds now. So the yuan bonds, we've seen actually multiple ones that have rebounded, some as much as 20 yuan here in just the last few minutes. So certainly that's one thing to watch here. Maybe, was the sort of selling pressure that we've seen, is that now in some ways easing a bit here? Obviously, there's been a lot of talk about, what sort of policy stimulus we might see from China year end or even next year to kind of rescue the rest that we're seeing in the property market. In terms of stimulus, I mean, in terms of the China side, Aoifinn, I'm just wondering how are you viewing it right now? I mean, it seems like a lot of attention, a lot of effort has been in developing this whole self-sufficiency, technological industrial power for China. At what point do they need to start really putting more stimulus in the consumer and property side of things?
It's interesting. And this is very much reminiscent of 08 and the banks and being too large to fail and letting 1 or 2 sacrificial lambs basically show that there has been a pullback and not necessarily support of every financial institution. That was in the US. Looking here now, there is a need even for a state-backed entity to show that they can survive with market forces, because otherwise they will never attract outside investor attention if there's going to be this essentially this backstop. So that there is this tension. And I'd say with regulation and policy change in China, there's always going to be a need to get the balance right between state support and market forces. So the investors are watching it closely. I think they see that they're leaning towards market forces.
Okay. In terms of how to play this Chinese market, I mean, there's been a lot of people talking about, the valuations are still looking pretty cheap. from the U.S. side of things as well. You're starting to see wobbles in markets that are very tech and AI driven, like Korea, like Taiwan. Do you think China, in terms of valuations, still look attractive to you?
I think it does look attractive, but it is going to be heavily skewed towards tech sentiment. We've seen that also to date. It has been basically a play on AI and tech. So it's not really offering true diversification, since the US is very much a play on AI and tech. So there's always going to be more emerging market risk factored into China when there is uncertainty, when there is a geopolitical development that puts it in the crosshairs. There will be a suggestion by investors that, are we getting paid for this risk? And right now, that the strong focus on the Chinese tech sector, I think that's something, though, that's not going to go away. I think it has piqued the interest we've seen about the ability of these AI companies to eat the lunch, essentially, of some of the more expensive and essential US models. So that factor has now become mainstream, and a focus on China there. As far as the China consumer, I think we do know that is a force that has been perhaps underestimated while China was out of favor as an investment entity for US and other global investors. And the Chinese consumer, despite some of the woes, all consumers are experiencing woes around the world, and they're not necessarily being reflected in markets. So I think that there's a sense that the Chinese consumer should not be underestimated in that respect.
In terms of the global AI trade, I'm just wondering, Aoifinn, obviously we saw fallout from the NVIDIA earnings. Obviously there's a lot of discussion about Google and Alphabet and how they have these chips that are a viable alternative to NVIDIA here at the moment. Where does that lead to when it comes to the AI trade? Some say this is a perfect opportunity to buy on the dip when it comes to NVIDIA. But some say, look, I'm still not getting that ROI when it comes to all this investment into AI at the moment. Where do you stand on that debate?
It's Thanksgiving Day today in the US, and we're going to be hearing a lot about menus and food. And I think investors are getting quite picky when it comes to their menu. At AI, they said, do we necessarily want the entire sector? Where are the winners? Where are the losers? Maybe I've overindulged. I've binged on that one. Now I should scale back and have more of a balanced diet. So that's happening within the AI sector. We've seen NVIDIA suffer and Alphabet do well with the recent with Gemini 3 and some of the suggestion that we shouldn't necessarily assume that first mover advantage will prevail forever. And we can also see other sectors really pick up. Something like an Urban Outfitters stock to go up 17% in a day. This is kind of grungy teenage clothing. So we can speak to the consumer, perhaps, but speak to just where investors have taken their eye off the ball of other sectors. Healthcare, Eli Lilly, getting one's eye off the ball when it comes to the drugs that are really changing lifestyles across the US in terms of GLP-1s. And looking at, again, who will be perhaps the next movers in that, not necessarily first movers, but will take market share quite aggressively. So a lot of, I think, looking beyond the obvious stocks right now, a desire to have that balanced plate when it comes to equity exposure.
All right, Aoifinn, hold that thought. Aoifinn Devitt there from Moneta. She's staying with us, and still it is getting late there in London, so thanks so much for staying up for us this hour. Some other stories that we're tracking for you today. Shein is under pressure from the EU to curb sales of childlike sex dolls and weapons on its third-party marketplace after French authorities flagged the products earlier this month. Regulators have asked the e-commerce giant to explain how it prevents the circulation of illegal products. The European Commission says it suspects Shein's system may pose a systemic risk to consumers across the bloc. Automaker Stellantis and China's CATL have broken ground on a $4.7 billion battery plant in northern Spain, a project that underscores Europe's growing reliance on Chinese technology. The factory is expected to operate at 30% of its plant capacity by 2028 and employ nearly 4,000 people, producing about 50 gigawatt hours of batteries annually by 2030. And Chinese ride-hailing giant Didi has reported a 67% rise in quarterly profit, a positive sign ahead of a potential listing in Hong Kong. Net income totaled $212 million, driven by solid momentum in China that offset losses in international markets. Didi, often described as China's answer to Uber, was forced to delist from the New York Stock Exchange after Beijing cracked down on data sharing practices across the internet industry. And coming up, we're going to be live in Hong Kong as police make arrests over a fire at a high-rise complex that's killed at least 44 people. Our very own Min Min Lo. Well, Hong Kong's worst residential fire in more than half a century has killed at least 44 people and left many missing. Police have arrested 3 people from an engineering company on suspicion of manslaughter. Let's get to our China correspondent, Min Lo. She's at the scene and joins us now. This is something that has, the whole world has been messaging me, asking, how is everyone doing? And it's just really our hearts go out to everyone right now with the situation. Just bring us the latest. What do we know at this point?
Yeah, I mean, just right next to me, there are dozens and dozens of fire trucks, and we just saw about an hour ago a new batch of firefighters coming in with their gears, changing shift with the other firefighters that has been in there. We saw them coming out looking just utterly exhausted, and it's been 20 hours since the fire started yesterday afternoon at 3 p.m. Originally a level 3 fire, but within 3 hours or so, it was upgraded to level 5, which is the highest severity. And up until now, we still don't know the exact cause of the fire. Authorities still say they are investigating, but they do know that the spread of the fire was far faster than what it usually would have been. And they said they found substandard materials here because this entire estate, there are about 8 blocks of them. They are all subsidized government housing, and they are 40 over years old. It was undergoing heavy renovation, so you can still see the remnants of those green meshing and the bamboo scaffolding. And authorities said that they found combustible materials, including styrofoam boards that were sealing the windows. They found tarpaulin sheets, plastic cloth, and so on that were not on par with compliance standards in Hong Kong. And so that's why a criminal investigation is ongoing, and they have arrested 3 people from the engineering company, accusing them of manslaughter and gross negligence.
Yeah, it really raises this whole topic of bamboo scaffolding, as you highlighted there, Min. It's something that Hong Kong has used for decades, this sort of way of building homes. Do you think this is going to intensify the calls to really phase out this sort of bamboo scaffolding now?
Definitely. I'm sure this incident is going to bring a lot of scrutiny to the issue of the bamboo scaffolding, which is a bit of a controversial topic here in Hong Kong because there are some residents who are just very proud of this dying art of bamboo scaffolding, something so characteristic of Hong Kong. It's a disappearing art that you don't really see anywhere else. But at the same time, starting from March of this year, the Hong Kong government had already begun to phase out bamboo scaffolding, citing the dangers of it because there have been construction workers falling from height. There has been cases of the scaffolding collapsing and killing the people below. There has been other cases of the scaffolding catching fire as well. And of course, this is the highest profile incident today that will certainly, increase the debate around whether or not Hong Kong should really rethink whether it should continue using these bamboo scaffolding. And I think residents certainly are demanding answers as to why those non-compliant materials ended up surrounding these buildings here. Why wasn't there inspections and better enforcement? Certainly a lot of answers that we are waiting for.
Min Lo, thank you. We got plenty more ahead. This is Bloomberg. Welcome back. You're watching Inside, and we're seeing when it comes to a rally here, it continues on for another day, although we are seeing just marginal gains at, a third of 1% to the upside when it comes to Asian stocks. But as we mentioned, global stocks are set to erase the November losses there, of course, on these Fed cut bets. Keep in mind, overnight, we also heard from the likes of JP Morgan flipping their forecast and saying that the Fed might actually cut rates in December now. They previously thought it was January where we would see the next cut. But they said, look, the pivot from Fed officials supporting cuts in the near term, notably from the likes of John Williams, the Fed Bank of New York, had pushed them to reconsider. Here with us now is Aoifinn Devitt from Moneta. She's back with us and still awake in London for us in the, 3 a.m. or so. Aoifinn, it's interesting, right? The amount of the switch that we've seen in Fed cut expectations. I think it was, just last week, we're talking about 30% odds. Now we're basically close to 80% right now. Do you think the clouds around the whole Fed rate cut path, is that just basically parsing now? Or are we getting more clarity on that front?
we get closer to the appointment of a new chairman, and now Kevin Hassett seems to be the favorite, that a little bit of uncertainty is clearing. If we have a strong President Trump supporter and advocate, as we're seeing in Kevin Hassett, there's even suggestion that rates could go below 3% quite quickly, and that would be a pretty substantial move. So that certainly is where the probability change came from. At Moneta, we've always expected some cut in December. We thought that the data was actually absent, so that was a problem. This is a data-dependent Fed, and especially after the shutdown. But still, the jobs data was coming in so soft, so murky, that there was a suggestion that even though inflation was not yet subdued, the focus on jobs and soft consumer sentiment would be the element that pushed essentially the Fed over the indecision edge into making a cut.
So how do you think this rate cut cycle is going to look like here? I mean, obviously, December, I think people are still, getting closer to thinking that that's close to being priced in. How are we looking at 2026? I think the market's still thinking maybe 3 more. Is this going to be more of a meeting-to-meeting sort of way on how the Fed's going to gauge whether to cut or not?
Yes, I think we're going to see the existing chairman show a lot of restraint, because that's been his kind of modus operandi up to now. He is on the exit side, so there's no need to necessarily attract any particular favor, and he will be data dependent. And I think that will be his hallmark, his legacy. Chairman Powell is restraint at the Fed. When it comes to the new chairman, then I think really all bets are off in terms of the pace of change. There is always the opportunity to make a bumper cut, and that I think will be very dependent on markets. It still seems to be that markets drive the Fed just as much as the Fed driving markets.
Does that mean, softer dollar and steeper curves moving forward for next year, Aoifinn?
A lot is going to depend on rhetoric, we believe. As it's interesting, the softer dollar kind of came about when there was a lack of confidence in the US around some of the geopolitical positioning, trade, a sense that perhaps US exceptionalism was on the outs. That was where we saw the weaker dollar. I don't think it was orchestrated. Now we've seen that the Fed has been really lagging other central banks in terms of cutting, but nonetheless, the dollar has been strong. And why has that been strong? We again return to just the sense of the US being the leader when it comes to technology. So even if rates are cut, if that leads to a very strong US economy and is actually the stimulus that really provides that growth that other areas around the world seem to struggle to gain, then it could well not necessarily mean a weaker dollar. We could actually have the strong dollar. And I'd say that the current strength in the dollar is evidence that it has not always behaved according to expectations and trend.
And when you're looking at, signs of risk sentiment, right? I think, the last few weeks it's really been crypto, as maybe some people say was the culprit and what led to the sell-off in November. We're back around 90,000 for Bitcoin now, but how are you assessing sort of this asset class, or at least these signposts here, and how to determine where risk is going to go?
Bitcoin has been an interesting indicator. Maybe that's been the canary in the coal mine around risk sentiment. There has been a suggestion that we still are sort of figuring out the discovery phase as to how Bitcoin is behaving. And we know that Bitcoin has been not a diversifier, not a hedge, not behaving like gold. It has actually been a pretty high octane risk asset. And that's why it's so difficult at a firm like Moneta to know where it fits in the portfolio, because we don't know its characteristics. Now it seems to be kind of an early indicator of investor sentiment going sour. And I'd say that has been more sustained than we might have expected. This weakness we're seeing in Bitcoin, there is a lot of expectation that it will continue to go down. There may be a bottom around about the 50s to 60s, but certainly lower from here. And that's because there's this discovery phase now, a shift to AI. The hype cycle may be coming to an end, and we may be in a sifting and discovery phase.
Okay. In terms of, as you look for your outlook next year, what sort of asset classes do you think are going to do well? I mean, obviously, there's been a lot of talk about private markets, and maybe that's where you're still getting the most returns here. What are you looking at in terms of your kind of pecking order of what's going to outperform next year now?
Well, we do know at Moneta that we cannot sacrifice growth. Our investors are long-term investors. They need to participate and have real returns after inflation. We think inflation is not yet subdued. We think 3% or higher is very likely in 26, particularly if there is more monetary stimulus. So in light of that, we need to participate in inflation-resilient assets. That means equities, but it means broad-based equities. Some of these sectors that were overlooked that I mentioned before, something like financials, healthcare, industrials, energy. Those are all areas that have perhaps had less attention, but they need to get attention. Global investing. not just China, Europe, areas that are more levered perhaps to the old economy, but are still trying to stimulate growth. And the talk in Europe, and I'm actually going to your offices in Bloomberg later today for a post-budget interview, Marin Talks Money, the Bloomberg live podcast, we'll be talking about just how the UK in particular is trying to stimulate growth. That's in everyone's minds. The action by the US and geopolitics may well have been the strong medicine that Europe and other areas needed to start focusing on their own economies and spending again. So that's a very exciting prospect for 2026. So looking global, and then, of course, keeping, yes, to private markets, keeping allocations there, but having much more selectivity in mind, not just following the crowd, looking at something like private credit, has it become overhyped, and looking then at real assets where we can get exposure to, again, that inflation resilience that needs to be across any portfolio. So I'd say a very optimistic outlook, but a need to be skeptical and not necessarily buy momentum trades.
Yeah, I was going to get your take, since you are in London, about this budget that came out overnight. It seems like they're talking about 26 billion pounds of tax increases in this budget. Do you think, Reeves did enough to really kind of balance the demands of what the bond market and what bond traders have wanted and what some of these labor backbenchers have wanted too?
Well, it's interesting. We'll see what the analysis is by Marin at the live podcast today. But I'd say it has not been received as badly as might have been thought. In the US, generally, high taxes would equal very negative outcome for growth. In the UK, the alternative to these high taxes would have been spending cuts. And the spending cuts, there was very little tolerance for that, very little budget, essentially, among the consumer to have an additional spending cut. The consumer here has already been under tremendous strain. They've come down. They're still experiencing higher inflation than elsewhere, still over 3%. There has been a lack of growth. There has been a lack of job creation, and that consumer cannot take any more. So perhaps the fact that this is the ultra high end that is being targeted by the taxes, they'll focus on Main Street versus Wall Street here in London. And I'd say that markets have received it quite well. It's been exceptionally well telegraphed, though. No surprises here. And that's been a new hallmark and calling card of the current government, is leaking information in advance. We can see that perhaps has calmed markets because they knew what to expect.
Thank you, Aoifinn Devitt, there, Senior Investment Advisor and Global Market Strategist at Moneta, joining us live from London here early this morning. You take a look when it comes to, we talk about the fiscal sort of discussion. Certainly, we got to talk about Japan as well, just given this sort of fiscal budget that just came out from the new government as well. That certainly is going to be the one thing that we're watching when it comes to some of these Japanese assets here today. But take a look at the Nikkei, right? We are back above that 50,000 psychological level for the first time in a week, and it's really been led by some of these AI shares, the electrical equipment, bank shares were also bought in as well. So really kind of support what we saw from the U.S. overnight as well. 156 from strength, slight strength coming through for yen this morning. The energy sector has been a big gainer from the AI boom in Japan. You take a look at Osaka Gas. They're looking to invest in more U.S. gas-fired power plants as a push to build more data centers drives a surge in demand for reliable energy supply. The president, Masataka Fujiwara, spoke exclusively to Bloomberg about their outlook.
Currently, the demand for data centers in North America and in Japan is key in driving the power generation business. Prices are determined by the equilibrium between supply and demand, but the volume of demand itself is increasing in Japan and America. The Japanese Ministry of Economy created the 7th Strategic Energy Plan this year, and within that, there is an expectation that electric power will increase from the current level of roughly 1 trillion kilowatt hours to 1.2 or even 1.6 trillion kilowatt hours. Nuclear power and renewable energy are simply not enough. Therefore, we believe that our very environmentally friendly natural gas-based power generation business has a sufficient chance to grow.
I understand that you also acquired the Sabine Oil and Gas Company back in 2019. How does that fit into Osaka Gas strategy?
Japan's population is not increasing, which makes the domestic market very challenging. Osaka is Japan's second largest city, but no new buildings are being constructed. For us, there was no way to expand the business domestically. So, we first expanded from Osaka to the entire country, including the Tokyo metropolitan area. But with many competitors, we realized that to achieve further expansion, we had no choice but to go overseas. North America is very stable, its legal system is solid, and for us, it is an ideal location for monetizing and growing the business. Therefore, we decided to venture overseas nearly 20 years ago. At times, we faced difficulties and failures, but today we are significantly growing three key areas in North America: Freeport LNG, independent power producer power plants, meaning natural gas-only plants, and Sabine. This is part of our strategy.
And President Trump wants a lot of investments into the energy sector in the United States. Are you planning to put more capital there?
There is the push from Mr. Trump, but also the population of the United States is increasing, and a number of data centers being built doesn't compare with Japan. Furthermore, demand is very strong. Even if the Democratic administration suddenly demands that all energy sources be renewable, I don't believe that is possible. Natural gas is an extremely important energy source. We believe this is true for both America and Japan globally, so we will invest fully in that sector. All of our know-how and technology are concentrated there, and since we can leverage our expertise in this field, we will focus on natural gas. We don't believe this will change significantly, even if the administration changes.
And that was the Osaka Gas president, Masataka Fujiwara, speaking to Sherian in Tokyo. Well, coming up, the UK Chancellor's budget gets a warm welcome from investors, but may not impress voters, facing $34 billion in tax hikes. We're going to hear exclusively from Rachel Reeves next. This is Bloomberg. Well, to Japan now, Bloomberg has learned that the country is planning to issue almost $74 billion in new bonds to fund Prime Minister Sanae Takaichi's economic stimulus package. Let's get more now with our Bloomberg economics and government reporter, Yoshiaki Nohara. Yoshi, there's been a lot of speculation on how she's going to pay for this. What more do we know at this point?
Right. So we know that she is going to issue the more extra additional JGBs to fund the stimulus package. But she's emphasizing another fact that, the overall issuance of JGBs for this year is going to be less than last year's. So she's obviously trying to, cool down some concerns about the fiscal health because of the spending plans she has.
Yeah, I mean, there was a lot of speculation whether she was going to be, Japan's Margaret Thatcher or Liz Truss. Do you think she's done enough here to reassure the bond market of fiscal responsibility?
I think it's too early to decide. One key question that the market is awaiting at this point is the content of extra JGB issuance. Looking for how much of that mix is going to be in the 10-year JGBs or shorter-term maturity JGBs. All of those small things are going to be important because we've seen over the past several months, that super long JGB yields have been very susceptible to any concerns in the market regarding the fiscal health. So we don't know the kind of details that the market is looking for at this point. We just know the overall size of additional issuance going forward.
Yoshi, we were just talking in the break about what an interesting start to her prime minister, her basically term, right? Because for one thing, she has to deal with fiscal expansion, which is something that she's campaigned on. On the other side, I think something that, we didn't quite foresee was this sort of China and Japan spat that continues on here. There was an interesting report from the Journal that President Trump, in that phone call with Takaichi, did actually urge her to not provoke Beijing when it came to the issue of Taiwan. She's basically dealing with multiple fronts here, just the first few weeks in office.
Well, it's a really difficult mix of challenges any prime minister would face, especially during the first month or two in the office. And as you mentioned, that the second part challenge, regarding the China tensions, this is not. I think it was not on the original agenda that she was thinking, but it's happening in the wake of her remarks regarding Taiwan. And she's in a difficult position because she will not be able to retract her comments, even though the Beijing is strongly urging her to do so. But at the same time, if she insists on that point, she can infringe the she can add some uncertainty to economic fronts, and possibly not just between Japan and China, but also trade truce that the U.S. has with China, because Taiwan is such a flashing point between the two nations.
Right. Yoshi, thank you. Yoshiaki Nohara there, our Bloomberg economics and government reporter. And meanwhile, the UK is turning to taxes to shore up its government coffers. Chancellor Reeves has announced $34 billion of tax increases in a budget that seeks to balance demands of both bond traders and members of her ruling Labour Party. Reeves spoke to us exclusively, and we began by asking about the unprecedented early release of the budget documents by the Office of Budget Management.
Richard Hughes and the OBR have confirmed that they have launched an investigation into what happened. It obviously was a serious breach. They've apologised for that and put out a full statement.
So, leak aside, are you happy with the market reaction today?
I think it's best for chancellors not to comment on what's going on in the markets. But what I was determined to deliver today, as well as cuts to the cost of living and cuts to NHS waiting lists, was cutting borrowing and the debt. And you can see in the budget today the increase in headroom, more than doubling the headroom to £21.7 billion, and indeed meeting that target on the stability rule a year early.
When you talk about cutting borrowing, the Institute for Fiscal Studies says it's a spend now, pay later budget. What do you say to traders who are still concerned that this fiscal tightening's backloaded?
Well, listen to the IMF, and the IMF say that there is a faster rate of consolidation in the UK than in any G7 economy, and we see that that borrowing as a share of GDP falling right through the forecast period. After hovering around 5% for many years, we are actually getting that down.
Well, the Resolution Foundation says this budget leaves much of the fiscal repair job to 2028 and beyond.
Well, some tax reforms, like the high-value council tax surcharge, take a while to introduce, and also we want to make sure that we get these things right. And similarly, the changes with the further freeze in the tax allowances, they're being frozen after they were already frozen for 7 years from 2028. But there are also real savings in spending right now, with better balance sheet management, cracking down on some of the waste and inefficiencies, and indeed introducing a further efficiency drive within our public services. So this is not all about tax. We've also taken measures on the spending side as well.
You mentioned the freeze on income tax thresholds for 3 years. It's going to create millions of new taxpayers. Do you accept that breaches the spirit of your manifesto?
Well, the manifesto was clear that we wouldn't increase the rates of income tax, national insurance or VAT, but I do recognise, and I said this clearly in the House of Commons today, that freezing the thresholds for a further 3 years after they were already frozen for 7 years under the previous government does mean that I'm asking ordinary people to contribute more. I think that is a fair thing to do in the wake of the productivity downgrade from the Office of Budget Responsibility, which will see £16 billion less come in terms of tax revenue. But I've kept that cost on ordinary working people as low as possible by closing loopholes in the tax system, and by introducing some taxes, for example, on EV charging, which the previous government ducked, even though it's been a ticking time bomb for some time.
But do you accept the OBR's conclusion that this stealth tax rise is going to reduce economic output because of the financial incentive against working in order to fund spending on benefits?
I think the OBR have been pretty clear that no measures in this budget impact their growth forecast. Indeed, they point to things like the India deal, the planning and infrastructure bill, as being positive for the economy. Well, and indeed, our changes to universal credit will result in an additional 15,000 people in the workforce in the next few years.
Well, overall, the ABR says none of your policy measures boost growth. What does that say about the government's growth ambitions?
Well, in the spring, you'll remember that they scored £6.8 billion, the biggest ever non-fiscal scoring that their OBR have ever done for our planning reforms. Just a couple of days ago, the planning and infrastructure bill was in the House of Lords. That is now almost complete, just one more return to the House of Commons, and then that bill will get royal assent. And the OBR haven't scored the India deal, the EU deal, or the US deal. And that's why I'm confident we can beat these forecasts on growth. We've beaten them this year with 1.5% growth now forecast, not the 1% they forecast in the spring. And I'm confident that we can beat those forecasts again.
So finally, Chancellor, you've effectively just broken your promise made after the last budget not to raise taxes again. Will you now rule out more tax rises, whether directly or by stealth, this Parliament?
So last year I had to close the black hole in the public finances left by the Conservatives. And in the budget last year, I lived within the forecast set by the OBR. They have now changed their forecast around productivity, and they are very clear that's nothing to do with the policy of this government, but that does mean they forecast lower tax revenue coming in. And I was always clear that I would never play fast and loose with the public finances, because it's ordinary working people and businesses that pay the price when that happens. So these are the fair and necessary choices in the circumstances that I faced. But what I'm now determined to do more than ever is to grow our economy so that we have the revenue both to keep taxes down and also to fund our public services. And that is what this government's plan for growth is all about. Whether it's pensions reform, planning reform, the changes today to help make Britain the best place to start up, to scale up and to stay, with the changes to stamp duty for shares for companies newly listing in the UK. I'm determined that we get the growth that our economy has been sorely lacking for too long, and we do that through the reforms that we've set out.
Well, no confirmation of no new tax rises.
Well,
Chancellor.
no Chancellor can write future budgets. I took the fair and necessary choices today, but my focus has been and always will be on growing our economy so that we can keep taxes down and have the money we need to invest in our public services.
That was the UK Chancellor of the Exchequer, Rachel Reeves, there speaking to our colleague Lizzie Burden. And as we talked about, right, the market did take it pretty well, this budget from the UK. Take a look at how, FTSE futures are looking like here. We'll see how we see day two of this, because we did see the pound rise to 132 levels here, extending some of those gains here this morning. And this recovery in gilt markets seems to be continuing as well. We're at 442 for the UK 10-year yield. Still ahead, we'll discuss the growth outlook for the APAC region with Natixis. The CEO of India's L&T Finance also joins us to discuss risks and opportunities in India's financial sector. Plus, more analysis when it comes to China's property woes with CreditSights. More to come in our next hour of Insight. Keep it here with us. This is Bloomberg. Welcome back. You're watching Insight. We're taking markets and, really we're focusing on what happens when it comes to this risk rally. Looks like we are continuing on here for another day. And really when it comes to global equities, we are on track to erase the volatility and losses that we saw in November. So that pullback in November certainly was that just a one-off. Now that we have seen Fed cut rates there really being boosted just the last week as well. Just really the likes of John Williams, I think, from the New York Fed, that really kind of shifted the sentiment here that, maybe they are looking more likely to cut in December. You have JP Morgan, also economists there flipping their forecast and saying, December looking more likely than January now. So you are continuing to see equities are up in Japan by about 1% here. We're back above that 50,000 level as well, of course. And we're watching, of course, the likes of Kospi and Taiwan still doing okay here today. Keep in mind, U.S. markets will be shut for Thanksgiving on Thursday. So we're dealing with maybe potentially lower volumes here in the next few days. But Bitcoin, that certainly is one thing to watch, right? We're seeing a bit of a a recovery. We're back above 91,000. That sell-off and really the relentless selling when it came to crypto was one of the reasons why we did see risk asset sell-off in November. At least we see that side and that asset class stabilizing as well. Certainly when it comes to Hong Kong break there, of course, we got to still check the bond space here and what we're seeing with China Vanke, right? So certainly there was a lot of wobbles here. We did see some of these bonds plummet to sort of record lows. We did see some suspension of some of these bonds earlier this morning. We have seen just the last couple of minutes, those yuan bonds actually rebound as much as 20 yuan, I should say. So that certainly maybe sees like there's a floor on all this as well, but there's still a lot of guideposts on what we need to see next year, in particular when it comes to any signs of central government support for the developers. So that's going to be front of mind. We have CreditSights there. Zerlina Zeng joining us here this hour to talk more about the implications. Another story that we're tracking is, of course, in the China tech space as well. The Pentagon is accusing major tech companies of aiding the country's military, recommending that Alibaba, Baidu, BYD, and others should be added to an official list. Now, Deputy U.S. Defense Secretary Stephen Feinberg informed lawmakers of the allegations around 3 weeks before President Trump and Xi met late last month in Korea. Let's bring in our Bloomberg Asia Tech correspondent, Annabelle Jewelers, on really, what do we know more about this? I mean, this was obviously, weeks before what happened in Busan. So what does it all mean?
Yeah, it's very interesting, the timing, as you say. The letter that we're understanding, because we've cited it or seen it at Bloomberg, but it's from the Deputy Defense Secretary, that's Stephen Feinberg, to lawmakers in the US, and it's dated October 7, so really close to that meeting between Presidents Trump and Xi on the sidelines of the APEC summit. But what you mentioned, some of the companies that are cited in it. There's Alibaba, there's Baidu, there's BYD. These are some of the best known names in China. But this here, you can see in this graphic, also goes through the 8 companies total. And I think it's really interesting to call out just the international significance of this, because you can see, for instance, InnoLight, Eoptolink as well. These are the optical transceivers that caught a lot of attention earlier this year, but they're essentially integral to building AI supercomputing clusters. They do have a lot of global clients. RoboSense is another, that's the second biggest LiDAR maker after Hesai, but RoboSense is a company as well that's actually involved as an NVIDIA partner in their robotaxi platform as well, their autonomous driving software project. So these are companies that have a lot of international partnerships and global ambitions as well. But yes, as you said, the content of this letter, so it's Feinberg sent this to US lawmakers. He called out these companies for having links to the Chinese military, and also recommended that they should be added to the 1260H list.
Yeah, what if it makes it on the list? How significant would that be? Because we've seen a few weeks ago there was an FT report that did talk about Alibaba's alleged ties to the military. They obviously denied it, but is it enough to spook investors, the scrutiny that we're seeing from DC?
It certainly spooks investors. When we had this 1260H list doesn't actually carry any sort of legal ramifications, so it is important to say that. But in terms of the investor sentiment, it sends a message clearly, because this is the US government saying these are the companies that we think have links to the Chinese military. Now, you mentioned Alibaba, and Alibaba actually did respond to our reporting on this morning as well, and they're completely denying having any sort of involvement. We've seen other companies like Hesai, for instance, pushing back strongly when, again, it had to fight these allegations earlier. But the market reaction, you're seeing a lot of these stocks a bit under pressure in the session today. Of course, it is a bit of a low conviction trading generally across the board. We're seeing in Asia today, so you're not seeing like huge outsides moved in them. But the list is only made public once a year, so that's important as well, because we don't actually know. You've got this recommendation. Has the 1260H list actually been updated? We won't maybe know that for another few months, because the last time it was made public was back in January. That was a time when we saw selling pressure in names like CATL and Tencent, for instance.
Yeah, how do you think this could evolve? Obviously, it seems like it could complicate where U.S. and China relations are going to be, given that we are in this sort of trade truce here right now.
Yeah, yes, I think that could definitely be an implication of this. In terms of the response that we've had, the Pentagon didn't want to respond any further on this story. It is a letter, I guess, in their view, that was dated again back several weeks ago. But China has definitely weighed in on this matter, and we did get a response out from the China Foreign Ministry saying that they want the U.S. to essentially course correct here. They're calling these actions as erroneous. I think when we think about the military links in general, it is important to note as well that there are a lot of big tech companies in the U.S. that have links into the U.S. military. So it's not abnormal to see tech companies having ties to defense. That is a playbook that you see in other parts of the world as well. But obviously the US is making a point here that these are ones that are actively involved with the PIA.
Sounds like you know a lot about this issue, too. Someone that's going to school on this very topic of defense tech. Annabelle Jewellers, our Asia tech correspondent, the perfect person to talk to us about this story, our tech correspondent there. All right. Another story that we're tracking in terms of the geopolitical side of things is President Trump reportedly advising Japanese Prime Minister Sanae Takaichi not to provoke Beijing on the question of Taiwan's sovereignty. Now, the Wall Street Journal cited Japanese officials saying Trump's move was worrying, suggesting he didn't want friction over Taiwan to endanger Washington's trade truce with Beijing. Now, Trump called Takaichi earlier this week, shortly after his hour-long conversation with Chinese President Xi Jinping. I want to bring in Alicia Garcia Herrero, the chief Asia-Pacific economist at Natixis CIB. She joins us live from Taipei. Obviously, I want to get your perspective on what you're hearing on the ground about this China-Japan spat. But, you know, the sequence of events, right? There was that call with Xi first that President Trump had, and then with Takaichi. What does that signal to you, really, on where things are going when it comes to this sort of issue?
For me, it's quite clear that Trump doesn't like the Takaichi's approach to this. Maybe I would say she may have been prompted by the conversations before the summit with Xi, Takaichi, Trump's first conversations. That if we recall, you know, the Trump administration was quite adamant before that summit that allies should show their support in case there would be an attack on Taiwan, support to the U.S. So, you know, in a way, it's kind of strange that once Takaichi made those comments, and have to say she did forget to say that would be once the U.S. would have intervened, because that's exactly what the Constitution allows her to do. But having been a little bit blurred on the message, to say the least, still, the Trump's lack of support in any way has probably surprised Takaichi. So in that regard, I think that there has to be a feeling of how lonely Japan is on this endeavor. And that will probably call to self-correcting measures by Japan. Maybe not outright apologies, but self-correcting measures, because the U.S. is not really clearly there.
Yeah, the journal kind of mentioned, you know, could this be some sort of new reality that we're seeing in relations between the U.S. and China, that it's not just about trade, but this Taiwan issue is very much linked now to these discussions?
Exactly. I think, you know, Trump is quite trapped with its own problems, affordability, latest election results in the U.S. So I think Trump does need a truce. I mean, and anything that comes in between is just not of his liking. That's what's happening, even for something as important as Taiwan. So I think that's you're absolutely right. We are in a different phase at this juncture. Will it be different once if Trump wins the midterm elections? I don't know, but there's a long way to go, and China's going to profit from that space for sure.
Alicia, we've been talking about just kind of what your outlook, you know, Natixis just came out with their 2026 sort of report. And it seems like you are seeing this sort of K-shaped economy, you know, not just in the U.S. You could extend that to China in some ways, where, you know, you're seeing bright spots like AI and the investment and the money that's being piled into there. You know, obviously in the U.S. there's tax breaks, but on the flip side, you also are seeing a weakening labor market, consumption that, you know, there seems to be a lack of confidence there. China seems to be going through the same exact thing. How long do you think the sort of K-shaped economy can actually last?
Well, the biggest problem, Yvonne, is that we don't know whether this is a K-shaped, cyclical K-shape, or is mostly a structural K-shape because of changes in the labor market related to substitution of labor by AI, but also, of course, in the case of the U.S., even more so, it's just technological progress. More generally is automation in China, AI in the U.S. I mean, all of this is pulling the strings towards less labor shares, we call it, less of less of a less for workers and more for capital, and that is true everywhere, as you said. But this has implications for nationalist movements. For everybody's going to try to get more of its own pie, and the pie is going to shrink. So K-shape, and the key problem is it structural? Is this structural?
For China, we seem to see some of the structural issues around the property sector once again reemerge itself. I'm talking about China Vanke now with the latest news. How tolerant do you think policymakers are going to be still on this property slump?
Well, I think Chinese policymakers are still kind of not ready to do much more for the real estate sector, because they've seen the economy grow without. We basically had the worst fixed asset investment in real estate in probably history, minus 14.7. Nothing happens. Growth continues. Why? Because we have this massive boom in export. So I think they probably think that they can cope with it. However, as you rightly point out, we're not out of the woods. We also have Vanke. I mean, all of these real estate developers can't survive without demand coming back. So I just worry that that policymakers feel that kind of underestimate the problem, because it's worked so far, but it may not work in the future. So, how much more time can you have these big developers suffering without demand is really a big question for the Chinese economy, especially because it relates to the financial sector. Not so much through developers, because the loans to developers now are very, very small, but more generally about local government supporting these developers. Those are like 15% of bank assets, and that's where the bulk of the problem is. So I hope they're not underestimating this problem.
And in terms of policy levers, what do you think they can address at this point?
Well, I think as we see it, next year exports will be tougher for China. For many reasons beyond protectionism. I mean, we even see the capex coming down for all of these export-related companies. So there's going to be less to export, still a lot, but less demand for those exports for sure. And that means that China will need to pull the strings of additional stimulus. What we've seen in 2025 is basically infra-related stimulus, not consumption-related stimulus. So I can imagine that they will keep on investing in infra, and the most obvious one is hydropower and upgrading the grid. And that's a lot of money that is needed for that. So I think they're going to just do more fiscal, not so much monetary, because rates are too low already, especially yields are too low in China.
When you talk about fiscal, I mean, it's interesting you mentioned that the Fed can continue to cut, but Asia's central banks are done when it comes to their rate cutting cycles. Tell us a bit more about that. Why do you think that they're done? Yeah. And do you think fiscal stimulus can actually kind of take the reins here moving forward?
Yeah. So BOK was done, as we saw this morning, and I think why is BOK done? It's because the won is just too weak, and this is true for many Asian currencies. We have, the high yielders, whether it's Indonesia or the Philippines, clearly too weak. Currencies are too weak to play around. If you see what I mean, it's risky. There could be sudden withdrawals of portfolio flows. We didn't see many this year anyway. It's mostly about FDI that has come into ASEAN. But, for that, I think you can't play with fire. The other example is Taiwan. The currency is just too weak. So can you cut? I mean, Taiwan wouldn't have to cut. On the contrary, they would have to hike. But, in case of Bank of Korea, it's just the only exception is RBI. I mean, they can cut. Because as we learned, there is a lot of space, but they are not comfortable with a very weak rupee. So the whole idea is currencies are already too weak. So it's hard to cut. If you've already cut, you front-loaded your cuts because you were worried of Trump's tariffs. So now your currencies are very weak. You don't want to cut more. Yeah.
You also mentioned about the tech cycle running out of steam for next year. How do you think this is going to play out? Because right now, everyone seems to be still so optimistic about the amount of investment that's going on into AI. In this part of the world, it's still relatively not as much as we're seeing in the U.S., so maybe there's still room to kind of invest in these sort of stocks in particular. But what sort of slowdown are you foreseeing, and how is it going to impact this part of the region?
Well, I would say beyond the usual suspect, TSMC, with demands that, like others that probably can't even cope with because it's kind of the bottleneck, or ASML in Europe. I mean, those kind of absolutely non-substitutable products. For the rest, there's going to be overcapacity. Everybody has invested massively, both hardware. If you think about the number of LLM models, open access in China, it's just competing with each other. So it's very hard to make profit out of this. And I think by the time we see that only a few companies can actually swim in terms of showing their financials, and those, as I said, are hardware but highest end, the rest are going to have a hard time for their valuations are just too high, especially in the US. But even in Asia, I would say that there will be a correction.
Alicia, it's great to have you. Alicia Garcia Herrero, their Chief Asia Pacific Economist at Natixis CIB, joining us from Kaohsiung. Taylor, when it comes to some of these consumer stocks in China, it's certainly interesting, right, what we're seeing here after Beijing announced new measures to boost spending. So they talked about here unveiling plans to better align supply and demand for consumer goods, including the likes of, you got this, collectible toys to boost growth. So PopMart, that's why you're seeing shares are popping there, climbed as much as 10%. We come off a little bit here, but you're seeing it, a lot of buying into the Laopu Gold, some of the smart sort of home sort of appliance makers like Haier, that's up about 1% here as well. So certainly that is one thing to watch very closely. How Labubus are maybe going to help in the lift the consumption story in China. Also, another thing in our deals team, Bloomberg has learned that China's Anta Sports is weighing a bid for German sportswear giant Puma. But the race won't be easy, as you see rival Li Ning and Japan's ASICS are also said to be in the running. For more, let's bring in Manuel Balgori, who leads our APAC deals coverage, on why do you think would Anta want Puma?
That's a great question, Yvonne. Anta has been quite acquisitive in the past. Remember 3-4 years ago they acquired in Finland Anta Sports to bring in new brands into their portfolio. So this would be similar. They would be buying an iconic brand that is somewhat struggling. Puma has been under a lot of pressure. The shares performance has been pretty poor. And under the new CEO, they're trying to come up with a new strategy to see if they can drum up a little bit more interest in the brand. But it remains to be seen. And in the meantime, some of the shareholders are also pushing the company to see, let's see if the new strategy works, but how about potentially we explore other strategic options? And that's where the likes of Anta or Li Ning or potentially ASICS come into play. There are not that many iconic brands that might be in play around the world. So whenever there is one, like Puma in this case, there is always appetite for sure. Yeah, you mentioned some big names that currently in the running as well, right? ASICS, Li Ning. Is this going to be a tough race for Anta then? It is slowly moving, Yvonne, and part of the challenging reporting that we faced is that the situation is at the very early stage, we understand, and there are different moving pieces. It's unclear how quickly things will be put together, but the companies are definitely doing some exploratory work with the hope that they accelerate somewhat in the coming months. Yeah, I mean, Puma is such an iconic German sportswear brand, Manuel. I mean, maybe not as big as Adidas, but do you think that a Chinese company would it meet some sort of resistance in any way? That's a great question. We've seen that resistance across many industries. Perhaps consumer retail is one in which European countries or other markets around the world are a little bit more welcoming. So I think the Anta Sports, Sports deal that I was referring to, that was a $5 billion deal a few years ago, and that didn't face a lot of opposition. I think, again, this might be one of the few sectors that are still a little bit easier to strike deals with Chinese buyers. Yeah, leaning Fila too. I think about that one also. All right, Manuel, thank you. Manuel Balgori there, who leads our APAC deals coverage. Coming up, we're going to be live in Hong Kong as police make arrests over a fire at a high-rise complex that's killed at least 44 people. This is Bloomberg. After that fire in a high-rise housing complex killing at least 44 people, many more
are still listed as missing. Let's get to our Minmin Lo, China correspondent. She is at the scene and joins us now. Minmin, I believe rescue efforts have been going on for close to 24 hours now. What's the latest?
Yeah, I mean, I can feel the smoke here. It is stinging my eyes. You can smell the putridness of the smoke. And it's been more than 20 hours, and we keep seeing new fires popping up in different apartments. And it just shows you how challenging it is to fully put this out. Because if you don't fully put it out and something is left smoldering, the fire would spread again. And it's popping up in different parts of these apartment complex behind me. There are 8 blocks in total, housing about 2,000 units, 4,000 residents who used to live there. And earlier this morning, we did see some people being wheeled out on stretchers, were rescued after being trapped inside for many hours. They looked conscious, but the rescue efforts, the firefighting is still ongoing, and it's been extremely devastating. There are a lot of Hong Kong residents who are here just watching the fire burn. I saw some of them just standing here quietly praying, some of them crying in tears. I saw residents who tell me that this is where they used to go to school, and they pass by this area every day. They have friends living there. They told me one of their friends who were affected is living with their relatives now with no idea what to do for the longer term future, because it's just highly unlikely that they will be able to recover any items from the homes behind me, because you just see the blackened shell of the buildings right now. And, you know, these families are just heartbroken and at a loss. Many of them just so shocked at how fast the fire had spread.
Yeah, can you explain what authorities have said so far? Why did it spread so quickly this time around? In particular, when it came to the bamboo scaffolding, too, Minmin.
That's right. So this estate is very old. It's about 40 over years old. It's government subsidized housing, and it was undergoing heavy renovation. So there was a lot of bamboo scaffolding. There were these green mesh surrounding the building, and authorities said they found substandard materials. They found flammable materials at every floor, and there were like styrofoam boards sealing the windows. There were plastic cloths, and these are all not up to Hong Kong's compliance standards, and that's why there is a criminal investigation going on. Police have arrested 3 people from the engineering company over manslaughter and gross negligence.
All right, thank you so much. We've got plenty more ahead. Welcome back. You're watching Insight. We're checking Indian markets here this morning. And an hour into trading, we are seeing still continued gains across those markets. Sensex is up about 0.4%, which is hovering around that 86,000 level here as well. And the IMF has and talking a little bit more about GDP, that certainly is one thing we're watching out for that's coming up as well. And then there's also this new FX regime, right? The IMF has reclassified India's exchange rate regime 2 years after suggesting that the country's central bank was intervening too heavily in the currency market. The Washington-based lender is now calling it a, quote, crawl-like arrangement, marking a change from the previous stabilized classification. We'll more or less bring in our South Asia economy and government reporter Anup Roy in Mumbai. Anup, tell us a bit more what this new classification means.
Yeah, so the crawl-like arrangement would mean that the IMF perceives that RBI is allowing more flexibility into the rupee. So under the new governor Sanjay Malhotra. So under the previous governor Shaktikanta Das, the rupee had remained quite stable. It did not move much. But since Sanjay Malhotra took over as the governor since December last year, the rupee has moved quite a lot. The rupee has moved some 4%, it has depreciated. So IMF is observing more flexibility in the rupee and hoping that it will continue like this. So from a stabilized arrangement, rupee is now into a crawl-like arrangement.
Okay, so what does it mean for the RBI in particular and the currency markets?
That would mean that rupee will be more market determined. RBI will probably not intervene much to determine RBI does not determine a level, but it does intervene frequently, depending on the volatility, etc. But a more flexible rupee regime would mean that the markets will probably have a greater say in the price discovery of the rupee. So that would mean that the rupee could be under depreciation bias if the tariff tensions continue, or if the tariffs are sorted out and FDI flows emerge, then rupee could appreciate more. So it will be more like market flow oriented.
Okay, in terms of the economy, what has the IMF said? It looks like they've maintained their forecast here for the economy to grow 6.6%. What assumptions are they making?
So IMF has increased the forecast for this current year to 6.6% from 6.4% they had said in July 2025. That is because of the strong second quarter, April, May, June quarter. However, for the next financial year, they have cut the growth forecast to 6.2% because of the tariff impact. Now they are saying that if the tariff impact, if the trade negotiations are done, if the tariffs are sorted out, then economy will probably go back to its potential of 6.5%. Indian economy otherwise is robust. Its external sector is good, but the tariffs will significantly impact US's exports to US.
Anup, thank you. Anup Roy there, our South Asia economy and government reporter joining us out of Mumbai. And we mentioned about GDP, right? India is set to announce its GDP growth data for the fiscal second quarter. That's going to be happening tomorrow, right? And for Bloomberg Economics, this is what they're expecting. Growth to have lost steam as weaker indirect tax receipts and a slowdown in services took a toll. However, excluding the tax impact, the economy is estimated to have expanded more strongly, and that's really driven by industrial output. Softer inflation is also believed to have boosted household purchasing power while easing input costs for firms. Joining us now exclusively now is Sudipta Roy, Managing Director and Chief Executive Officer of L&T Finance. It's one of India's leading non-banking financial companies and a unit of the multinational conglomerate Larsen & Toubro. Sudipta, it's great to have you. Obviously, we've been talking about a lot of the GST 2.0 reforms that really have reflected in consumption demand. How do you see these tax cuts really reflected when it comes to that demand picture here, and does it change your growth projections in any way?
Yeah, thanks, Yvonne, and thanks for the opportunity. I think the GST 2.0 reforms, in which we saw the sort of GST rates being sharply revised downwards for most consumer items category, actually gave us a very good fillip in the festive period, which is the Diwali period, which happened in October of this year. And some of the categories saw very good growth. For example, in our two-wheeler segment, two-wheeler segment saw a massive growth. For example, if I look at last year's demand at an index of 100, this year's two-wheeler demand was almost at 230, as per the recent data sort of published by TransUnion CIBIL. The auto loans also saw a good amount of growth, 12 to 14% growth, as well as consumer durables also saw a good amount of uptick. So overall, the task that GST 2.0 had of spurring consumer demand actually has largely sort of hit where it was supposed to hit. And as far as lenders like us, we have seen a very, very good growth rate in the month of October. If I look at my October 25 to October 24 growth rate, in our retail disbursements actually grew by a whopping 39%. So overall, yes, the demand has perked up. And as lenders, banks and non-banking financial companies like us are also stepping up on the credit.
And it's interesting, right? I mean, this is coming at a time when there's a lot of competition in the financial services space in India. A lot of foreign players are obviously joining into the rounds here, Sudipta. How do you plan to at least compete in that sort of landscape now?
See, I think the Indian market, and a little earlier we were talking about the GDP growth rate. Our internal estimates of, though the IMF GDP growth rate estimate is around 6.6, our internal estimates of GDP growth rate for this year is about 7%. The reason I say that is that because rains have been very good, about 112 to 114% of long period average. The rural wage growth rate is very, very strong, between 5 to 8%, and we are seeing a resumption of consumer demand. Now, India is a vast country, and if you see credit growth rate last year, obviously retail credit growth rate last year was between 10 to 12% depending upon the region. And this year, RBI obviously has been focusing more on the growth story getting going. And given the vast nature of the country and the large amount of consumer sort of throughput, 60% of India's GDP is driven by domestic consumption. There is a lot of space available for both banks and non-banking financial services companies to lend. For us specifically, we are a very balanced sort of asset profile. About 44% of our assets is in rural areas and about 56% of our assets is in urban areas. So we actually straddle both rural and urban. And for us, we are a very, very large player in the urban area. We're the second largest microfinance lender. We are a very large tractor lender. So we expect that the growth that is coming in the rural areas will help us also grow our balance sheet, as well as we partake a lot of growth in the urban areas as well, especially in the two-wheeler segment, the personal loan segment. The personal loan segment actually has started growing quite well. The growth in the last 3 months in personal loans origination has been upwards of 30% in the industry. For example, our book has grown by almost 90%. So this growth has been overall secularly strong in the last quarter, and we expect the same growth story to continue in H2 as well.
Are you currently in any talks with any foreign players or even PE firms to raise capital then?
No, I think we are pretty well capitalized. And for us, we are currently at a debt equity of about 3.5. So, where we are positioned right now, we have enough capital to sort of suffice for our next 2 years of growth. Maybe, we will look at a capital raise sometime around middle of FY27 is when we will look at FY28, which is calendar 27, is when we look at a sort of capital raise.
And in terms of what sort of AUM are you targeting maybe here for the next 3 to 5 years now?
Good question. Right now we are about 1 lakh crore, which is a little about $12 billion. And in terms of our AUM growth sort of projections, we are targeting a very strong growth. As you know, the Larsen & Toubro Group runs a 5-year sort of planning exercise every 5 years. It's called the Lakshya, or the target. So we are at the fag end of the Lakshya 26, which we started in 21. And our sort of compounded annual growth rate target at that point in time was about 25%. We are now at about 28%, and we have grown pretty well. So we are at the beginning of the Lakshya 31 planning exercise, and we will give out these numbers out in the beginning of the next financial year. But I can assure you that the growth rates that we have planned will be upwards of 2 times or even more than that in terms of AUM growth rates over the next couple of years. We do believe that the growth momentum in the Indian market is quite strong, and given our asset profile, we should be able to grow equally strongly in the urban areas as well as the rural areas. And as a well-capitalized NBFC, we intend to partake in the growth in both the sort of markets.
Yeah, given the growth that you're seeing, Sudipta, are you looking to, launching any new sort of product offerings, or at this point, are you looking at scaling back some existing businesses?
So we just recently entered our gold loans business. We actually did not have sort of a gold lending business, which is a very large and fast-growing business in India. In fact, it has been the fastest-growing retail asset class in India last year. So we wanted to partake in this business because when we looked at our sort of rural customer profile, we saw that our rural customer base has borrowed a huge amount of sort of gold loans, upwards of $2.5 billion of gold loans that has been borrowed by our rural customer base. So we said that this is a business where our customers are borrowing from others. We need to get into this business. So we acquired a small boutique gold loans firm and integrated into our business around the June of this year, and we are now setting up new branches. In fact, we'll be setting up 200 new branches this year, almost at the rate of 1 new branch every day for the rest of the year. So that is one new business that we have gotten into. And obviously, we look at expanding our current line of business like microfinance, personal loans, mortgages, our two-wheeler business, and our SME business. So we will focus on growth on our existing line of business as well as on our newly acquired business. We will scale it up.
You mentioned microfinance. Obviously, there's been the surge of non-performing assets earlier this year. Where are we, do you think, in this crisis? Do you think we're out of the woods just yet?
Yeah, so in microfinance, actually, we were probably the least impacted. If you see the microfinance industry sort of loss rates last year in India, the loss rates, depending upon the lender, varied between 8 to 12%. So obviously, we have seen a deceleration of the sort of the origination momentum as well as the overall microfinance book size also shrunk by almost 20% for the industry. For us, we were the least impacted. In fact, but we are now the second largest lender. We were the fourth largest lender because of the sort of readjustment in the industry. We have emerged now as the second largest lender. Our loss rates were quite low during the period. We are actually the lowest. We came in at about 3.8% loss rate compared to an industry average of 8 to 12%. And because we sort of managed the crisis well, we are able to gain market share right now. During the period, our market share gained by almost 1.5%. And I do believe that the industry is almost out of the woods. Maybe a little bit of long tail of that particular asset crisis remains. But I do believe that the industry will go back to its growth path in about another, couple of months. However, there is a little bit of a liquidity issue in the market because some of the players are actually finding it difficult to generate enough liquidity to lend. So moment that gets sorted out, and the industry regulatory body is also engaging with the government on that as well. And moment that gets sorted out, I do believe that the industry will resume its growth path. However, with a lot of degree of caution right now, and I do believe that the growth rates in the industry will be muted in the coming future, and probably we will see not more than 5 to 10% growth rate in the industry.
Sudipta, it's great to have you. Sudipta Roy there, MD and CEO at L&T Finance. And still ahead on Inside, China's real estate sector suffers another blow as state-backed China Vanke proposes delaying repayment on a local bond. We'll get analysis from Zerlina Zeng on CreditSights next. This is Bloomberg. More now on developer China Vanke's surprise proposal to delay repayment on a local bond, which is renewing concerns over a deepening housing crisis. Joining us to discuss this is Zerlina Zeng, head of East Asia Corporates and Asia Credit Strategy at CreditSights, and she joins us from Singapore this morning. Zerlina, it's great to have you. It seems like we have you on every time there is a bit of a problem when it comes to the credit market in China. When it comes to this Vanke issue, some analysts saying, they pointed this move as maybe coming a bit earlier than expected. Were you surprised by this move?
Thanks for having me. I think the delayed payment of the onshore bonds, this timing is slightly early than our expectation, just because the company earlier said they did have funding for at least a maturity by year end. And there's the big policy meeting in December. So we would have imagined maybe in early next year, the company will go ahead with certain type of debt restructuring, but the timing is a bit early than our expectation. That having said that, I think since earlier this year, we have mentioned this company's standalone credit profile has been very weak, and all the pricing and all the trading is really hinged on the government support. And we are quite cautious about this type of company when the self-funding or the self-internal fund generation has been weak.
I mean, people are talking about the worst case scenario, right? In the event of Vanke potentially defaulting, what sort of implications do you foresee this could have on the sector?
I think the incremental negative impact on the sector or on the broader China credit market is actually quite limited. If you compare this with when China Evergrande or Coguard defaulted a couple of years ago, for a few reasons. The first is just if you look at the index level, China high yield property is less than 5% of the index weight versus 2021 it was more than 50%. And from a market impact perspective, back then, the major participation in China high-yield property bond are the real monies, the institutional investors, private banks, but now it's mainly the fast money. And because of this ongoing China property sector slowdown, I think people are to some extent expected that the Vanke is going to restructure debt at some point. It's just the timing is a bit earlier than our expectation.
Well, at what point do you think policymakers are going to be forced to step in some way? Do you foresee any sort of new property measures that could be unleashed because of what we're seeing with Wanke?
We don't expect any major property measures towards the developers or for the governments to save the developers. Actually, if you look at the past few years, the central and local government, they haven't really saved any property developers or bail out any bondholders. I think on the ongoing basis, you will continue to see incremental small measures driven by the local government. But in terms of nationwide additional new money towards the property developer sector, I think it will be very limited. The central government has reaffirmed their stance that the new driver for the economy will be high-end manufacturing. It will be technology and other sectors other than the property. They no longer see property as the biggest driver for the economy. So we will be very surprised if next year the government decides to go ahead and bail out the property bond holders, or they would push out a lot of the stimulus towards the sector.
It's interesting. Some have said that, given what we're seeing so far, that there really has been no let-up when it comes to what we're seeing in the property sector, that eventually policymakers are going to move from just saving projects to actually saving developers themselves. You don't see that happening?
I don't think the government is going to save the developers because China's property market has been much smaller compared to 5 to 6 years ago. So in theory, the government does not need that many developers, especially coming from the private sector. So right now, the outstanding or still performing state-owned developers, they could support the market in terms of the new home supplies and the ongoing build-out of the secondary projects. And in the China market, people are not looking into the primary market anymore. A lot of people are looking into the secondary market because there is enough supply and they might be able to get a huge discount in the secondary market as well. Going forward, definitely the government will still looking at those incomplete home projects. There will be additional funding towards the delivery of these home projects, but we don't think the government is going to put in a lot of additional new money to save the developers.
In terms of property sales, then, if we're not going to see meaningful support from the government, what are you foreseeing? Or what expectations do you have in terms of property sales for next year, then?
We think property sales will likely still go down and home prices will continue under pressure, especially in lower tier cities. Even if you look at upper tier, first tier cities such as Shenzhen, Guangzhou, in certain districts, the prices still continue going down. The root problem is still the home inventories is very elevated in China, even though we see a lot of measures getting pushed out by the central governments trying to digest this home inventory, but level is still very elevated. You basically don't see that much incentive from banks or the asset management companies to pour in new money to resolve the home inventories. Definitely there are measures about developing social housing to buy the existing inventories and convert them into the social housings, but this does not resolve the issue of still elevated inventory in the system. Going into next year, I think the government will likely look at the pace of the price decline in both the primary and secondary market. They will also monitor the local government's budget conditions because of the lack of land sales. But overall, we are not seeing a very high chance of additional credit contagion or additional spillover to the general macro economy. So I think it will be very difficult. The hurdle is still very high for the central government to push out very big measures towards the sector.
Zerlina, I want to end on a slightly positive note. When it came to news on New World. So they did get a bump in support when it came to this debt swap proposal. This is a pretty small win, I guess you could say, for bondholders, but what do you think comes next when it comes to New World?
Yeah, so when we looked at the exchange offer, we definitely think it was a positive sign that the family decided to throw in Victoria Dockside, which is the crown jewel assets for the bondholders. We had expected that these crown jewel assets would have been reserved for the bank lenders. So in terms of the security package, this is definitely to some extent compelling for the bondholders, but the security package itself is not direct collateral against the new dollar bond. So it is also a little bit of surprise of us that the take-up rate is so high. Our fair value estimate for the new dollar bond was around 85 cents, and now it is trading above 90 cents. So from that angle, it is not so attractive, but I think a lot of the investors are pricing the scenario there might be additional equity injection from the family as well as from other equity holders. So for those betting on the equity injection scenario, there could be some additional price upside. We have cautioned that this is not something that real money investors or those with buy and hold strategy to get into. Right now, the involvement is very much from the fast money, and trading has been very technical. In terms of the next step, I think the company will need to continue addressing the outstanding dollar perp, the existing perp, so they could clear the hurdle of that dividend stopper and then pave a way for the additional equity issuance.
Zerlina, thank you. Zerlina Zeng there, head of East Asia Corporates and Asia Credit Strategy at CreditSights, joining us out of Singapore. Just one more last check of markets here right now. Looks like we've lost a little bit of momentum here on the back of this rally, but global stocks are actually on the rise there for a fifth straight day. They're really kind of cutting that drop that we saw in November to just about, 0.5% here right now. So looks like we are actually still seeing some green here, really led by the likes of the Nikkei 225, Kospi and Nifty also are seeing some gains here as well. Before we go, here's a look at some of our guests for tomorrow. We'll get insights on the latest investment opportunities in the region from Capital Group's Andy Budden. And for our India Focus segment, we turn to the upcoming GDP report and preview the growth numbers with Nomura's chief Indian economist, Sonal Varma. That's it for us here in Insight. Horizons Middle East and Africa is next. This is Bloomberg.